What makes you a finance rock star, a real heavyweight? It's ratios. I'm going to show you the activity ratios that are important to know, what they mean, how to do them, and how they will shed so much light on your business or other businesses. Watch and wait till the end, because at the end I'm going to make a song and play it for you, and it's going to show you everything that you learned and make it easy to remember and understand. Alright, here's a preview of what we're about to learn. Let's go. Okay, so check out this example company over here, Gym Bros. Gym Bros, they're heavyweight lifters. They really are into their weights and their protein shakes and whatnot. They'll teach you how to get really ripped, but they really don't understand their finances all that much, so we're coming in to help them out. So very simple income statement up here, balance sheet down here. We've got the prior year end values and the current year end values over here, and this is the important part you got to know. We have to get these averages in. They'll be very helpful for the calculations that we're about to do. So let's jump into the inventory turnover. Now, I've seen companies fall apart over their inventory practices because a lot of the times they'll just buy too much, or they'll have a lot of inventory and it gets stale and stagnant and isn't selling. They'll not buy enough. So when you are looking at the inventory turnover, that tells you the speed that they're burning through their inventory. If you see it fluctuating and it's going upwards, it means they're being more efficient in their inventory purchasing. If it's going downwards, that tells you they have too much inventory compared to prior periods. So here's the calculation of the inventory turnover. What you'll take is your cost of goods sold for the period, in this case it's a year, and then you'll divide it by your average inventory amount. So when you divide, that gives you a return of 20 turns per year. So that's telling me that they have burned through their average of $4,000 of inventory 20 times during the year. That's actually on the high side. If you would see that it's starting to go lower and it goes from 20 turns down to 10 turns, that's when you start asking questions. What changed? Why are you slowing down in your inventory sales? If it spikes up, you also need to ask questions. But like any of these ratios, numbers like this, when you see them changing, that tells you that something operationally has gone on and it's time to start asking questions. The other thing is, when it comes to ratios like this, it's important to keep in mind that you can use this to gauge it against other companies. You're considering purchasing a different company and you have a look at their inventory turnover. Oh, it's far off of this one. Why? Now, days of inventory on hand, so that tells you the same information but in terms of time. So if you take that same ratio, the 20 coming from the same spots, and then you take 365 days in the year, and it's got to be the same period that the income statement and balance sheet are covering. You take the 365, you divide it by 20, and that will result in 18.3 days. So what that says is if you have $4,000 of inventory, it will only take 18.3 days to sell it all. Receivables turnover. This is pretty much the same concept as the inventory, but now we're talking about how many times a year are you able to burn through your accounts receivable? Meaning, if you have $15,000 average of accounts receivable, how many times per year would you be collecting that $15,000? So if you are generally creating $250,000 of revenue and your average receivables would be $15,000, that means you collect all of your receivables 16.7 times per year. And now we're going to see the same thing where we turn it into days. So days sales outstanding, you take your 365 days a year and then divide it by your receivables turnover, your 16.7, and that tells you it will take you approximately 21.9 days to collect all of your receivables that are outstanding. Payables turnover. Same concept. In this case, we're looking at your cost of goods sold as it relates to your trade payables. And keep in mind, when you're doing this, it can get really tricky. You have to make sure that your payables that you're looking at relate to the cost of goods sold that you're looking at. If you have say rent payable mixed in with the trade payables, that will reduce how meaningful this calculation is. So keep in mind that the devil's in the details, and when you're doing this, make sure your accounting is done in a way to make this easy. So anyway, if you take your cost of goods sold of $80,000, like it shows up here, and then divide it by your average trade payables, that will show you that your payables are turning over 11.4 times over the course of the year. So this is showing you how quick you are at paying off your accounts payable related to this. So if it's moving upwards, that could tell you, hey, you're paying faster, you have more liquidity, you're able to pay your bills faster. It could also mean that you're not taking advantage of the available terms that you have with your vendors. You could be paying a lot slower and then keeping more liquidity to yourself, but instead you're paying it quickly. Days payables outstanding. Okay, same thing. Take that ratio, take the days of the year, divide one by the other, and you get 31.9 days. So that's telling me is on average it takes 32 days for you to pay off your accounts payable. Working capital turnover. Now your working capital is not covered in other ratios over here. So you have your working capital and you have your revenue. You're going to divide your revenue by your working capital. Your working capital, that's the money that you have to play your game, right? Buy new weights, buy new protein shakes, etc. So the idea over here is we want to know how quickly the revenue is replenishing that working capital. So in this case, your revenue is $250,000. Working capital is your current assets minus your current liabilities. We're going to take the averages over here. So on this balance sheet, that's cash, receivables, and inventory minus trade payables. So that's going to give you a net average working capital of $24,500. So if you take your $250,000 divided by the 24.5, that's telling me that on average you replenish your working capital about 10 times per year. Fixed asset turnover. Okay, now this is telling you how much revenue your fixed assets are generating. Now, it's not going to be cut and dry. Sometimes fixed assets don't generate any revenue. Sometimes businesses don't even have any fixed assets. So before you dive into this one, you first have to figure out like what makes your business tick. In this case, we have a gym, and what makes it tick is a handful of things. They have good gym equipment, okay? So how much revenue is that gym equipment generating? They have good products that they sell, protein shakes and whatnot. That's also generating revenue. And then they also have really good staff. The staff are there helping people lose weight and get stronger and whatnot. So when you are looking at your business, you have to figure out where your revenue generation is coming from. So this ratio over here is taking the assumption that our fixed assets are what's generating the revenue. That would mean your gym equipment is driving people to come in and pay to have their memberships. Okay? So if you have an average of $55,000 of gym equipment, and that's generating $250,000 of revenue, then your fixed asset turnover is saying that you are getting 4 times your fixed assets over the year. Okay, again, this is one of those things. You want to watch if it's going up or going down. Ask questions if you see big changes. If you go and double your investment in gym equipment and you see that your revenue doesn't double, then maybe you bought too much. Maybe you need to wait a little bit longer. But that's what this ratio is coming to shed some light on. Total asset turnover is basically the same idea that we were talking about with the fixed asset turnover, but this is with the assumption that all of your assets together are generating your revenue. It could be fixed assets have nothing to do with your revenue generation. You know, could be you have no equipment, you have no fixed assets. Could be you're a software company and you just have a couple laptops, and really what's generating your revenue is something completely different. So you'll have to weigh it out to figure out where your revenue is coming from. If it's something on the balance sheet, you take its average and then you divide your revenue by it. So this total fixed assets is just taking a broad view of it, assuming that everything is driving it. So if you take your total revenue of $250,000, then divide it by your total assets of $86,500, that's going to show you you're basically burning through the value of your total assets about 3 times per year. That's it. You survived. I'm so proud. Now, take some time. Go back through that again. Let it sink in. And also, stay tuned. I'm about to show you a song that I put together to make this easy to remember. Maybe you'll laugh while you're at it too.
Welcome to Jim Bros Finance. We curl spreadsheets between sets. We deadlift numbers till they confess. Coach yells racket, I yell track it. Inventory turnover is cost of goods sold divided by average inventory. If turns go up, those tubs are sprinting out the door. Tubs go down, the way is taking a nap on the shelf. Days of inventory on hand is number of days in the period divided by inventory turnover. How many days till the chocolate thunder powder disappears? As days equals more flat. Count the reps, bro, count the reps. Pre-workout for the brain, this is math with biceps. Shorter days, faster plays, business gets tight. Ratios make the gym money strong and bright. Ratios make the gym money stop right. Claim says spot me, I say pay me. Receivables turnover is revenue divided by average receivables. More turns means cash hits the bank like a slam dunk shaker bottle. Fewer turns means that invoice is ghosting your DMs. Day sales outstanding is number of days in the period divided by receivables turnover. How many days till the dollar stopped doing cardio and finally sit in your account? Vendors bring plates, we bring thanks. Payables turnover is purchases divided by average trade payable. Higher turns means we pay fast like a caffeine sprint. Flake on sprint. Lower turns means we stretch turns like a yoga bro. Whoa, who talks about balance? Days payables outstanding is number of days in the period divided by payables turnover. How many days till the vendor stops texting, where is my money? Average working capital is cash plus receivables plus inventory minus trade payables averaged over the period. Working capital turnover is revenue divided by average working capital. That is how many times the fuel tank refills while we blast classic rock and South Beach Mango. Fixed and total assets. Fixed asset turnover is revenue divided by average net. Fixed asset. If the turns climb, the squad racks are earning their rent. If the turns sink, that shiny leg press is just a photo booth. Total asset turnover is revenue divided by average total assets. Zoom out, bro. Every pound of asset should be pulling like a sled dog. Count the reps, bro. Count the reps. Turnover is tempo. Cash is a set when the days get shorter and the turns go higher. That is financial fire. Cue the protein choir. Live smart. Sell shakes. Ask questions when numbers change. Jim Bros